ค่ะ
Sawadee krap, everybody. Good morning. We will do the presentation as usual in two parts. In the first part, we will discuss the industry structure, and in the second part, we will discuss the specifics of the company and the financials. As you all are aware, pressure shipping is part of the dry bulk tramp freight market, which means that that's a good reminder to turn off your mobiles or put it on silent. So, as I was saying, pressure shipping is part of the dry bulk tramp freight market. Therefore, please keep in mind that we do not carry any containers, neither do we carry any liquid cargoes. All we carry are dry bulk commodities. In terms of sizes, we are mainly focused in the small handy size sector of the market, and we have a few ships on order in the Supramax sector. This is a snapshot view of the company. We currently own, operate, and control 21 ships. The average age is 15 and a half. The gap between the market value of these ships and the book value of the ships is approximately $125 million. So this is like a hidden reserve. It's not shown on the balance sheet anywhere. And the average size of these ships is about 25,000. If you look at the lower portion of the slide, I've given you the value of these ships at different points in time, and you can see how volatile the asset values in this industry are. And therefore, it is essential that when you are renewing the fleet, you do that at a time when asset values are weak. Otherwise, you can get into serious trouble, as you can see from the change in valuations that I've shown you at the bottom of the slide. This is a snapshot view, a long view of the Baltic Dry Index. Please keep in mind the following facts. The Baltic Dry Index consists of 4 sub-indices. The 4 sub-indices are the Cape Index, the Panamax Index, the Supramax Index, and the Handysize Index. There is equal weightage given to each of the sub-indices, and therefore you would be forgiven if you assumed that the BDI is representative of all sectors of the market because of this equal weightage. But in fact, because the Panamax and the Capesize sector fluctuate much more than the Supramax and the Handysize, the BDI ends up being more a reflection of the larger ships than of the smaller ships. And as you can see, I've put down in the yellow box for you a lot of information about the BDI in terms of what has been the all-time highs, what have been the recent highs, what have been the recent lows, and what has been the all-time low, and what is the largest fall in a single day. So that again explains to you the extreme volatility that is faced by the industry. Now, if you were to look at averages, it gives a much better picture. And you can see here that the BDI has a sort of a cyclical trend, with a low cycle point being at the beginning of the turn of the century in 2002, going up to a high point in 2004 before falling for the next 2 years, and once again coming up to peak points in 2007 and 8, and then again coming down. Now, if you look at the downtrend, it was quite sharp between 8 and 9, and then in 2010 it sort of went up. We think that 2011 and 12 will be really low and may even look like 2002. So you can see that we're heading towards that direction, and from pressure shipping's point of view, that would be perfect to buy ships at that point. So this is where we are heading towards. Coming to the demand side of the picture, what I have here for you is the demand for the 5 major segments of dry bulk commodities that are carried by ships in our sector. This research is from Clarksons Research Studies. It's the single largest broker in the world, listed on the stock market in London, and they have been providing this type of research for many, many years. If you look at the box on the top right hand corner that I have for you on the slide, and look at the percentages of the different cargoes, you can see that iron ore is at 30% of the entire demand side of dry bulk commodities. Coal is 27%, almost neck and neck with iron ore. And if you add steel into that picture, then you can see that between these three commodities, you are covering 75% of the demand side of the business. Or 65%, sorry, 65% of the demand side of the business. If you add grains to this picture, then it's 75%, and the minor bulks are the balance 24-25% of the market share. Pressure shipping is part of the minor bulks. We carry all of that, and we also carry grains and steel. Pressure shipping does not carry iron ore or coal, which is generally carried in larger ships. But once we get the Supramax ships into our business, then you will find that we are also carrying coal cargoes. But we would, generally speaking, not carry iron ore, which generally travels only in very large ships. Now, there is a seasonal impact in the Baltic Dry Index, and what I've done here for you is that I have taken 25 years of the Baltic Dry Index and plotted it on an annual basis. And you can see quite clearly that in the months of July, August and September, generally speaking, the market does come down. The reason for this is twofold. Firstly, industrial production in the OECD countries comes down during these months because the OECD countries traditionally go on holiday during the months of July and August. Therefore, raw material shipments coming in the month of June and in the month of July, August and September is generally slower than the rest of the year. Secondly, if you look at the grain movements in the world, the export of grains from the southern hemisphere, that is from the grain exporting countries in the southern hemisphere, finishes by the month of June. And the grain exports from the northern hemisphere does not start till the month of October. So generally in the months of July, August and September, there is very little or almost zero grain movements in the world. So if you remember the previous chart, as I told you, iron ore, coal, which are essential parts of the industrial production complex, and steel, coupled with grain, works out to almost 75% of the demand, and that 75% slows down during this part of the year, and therefore you have this seasonal impact. Now, besides the seasonal impact, what we noticed is that there were a lot of exceptions coming in. And so we split up the slide into two parts. If you look at the blue line, that is the period between 1985 and the end of the last century, that is 2000. And there you can see the impact of grain movement slowing down and the impact of the industrial production in the OECD countries very, very sharply. But since 2000, if you look at the red line, you can see that the impact from the slowdown of industrial commodities is almost zero. And the only slowdown impact is from the lack of movement of grain. And the reason for that is that since the turn of the century, China has become the manufacturing capital of the whole world, and they don't take any holidays during the summer months. However, if you notice and look at the pink line in the month of February, you can see a very sharp downturn and a very quick uptake. And this is because of the impact of Chinese New Year celebrations, where China literally closes down for about a week or 10 days. Therefore, the impact is very sharp, but it also bounces back very quickly because China doesn't go on holiday for 2 months like the Western world. It just takes about a 10-day break. So, but that can be seen quite clearly as to that this will happen almost without fail. Coming to the supply side. If we look at the supply side, we can see quite clearly that supply is growing almost on a daily basis.